Hello everyone, this is Sahil and welcome back to the channel. With this video, I'm starting up a new segment. This segment will cover any fresh news out there which might affect our investment decisions. And the first one is a big one. US has banned any investment into a company that might be controlled by the Chinese military or have ties to them. Awesome shit. So in this video, let's discuss what exactly is happening and what should we do going forward to take advantage of the situation. Let's hit it up. All this started with Trump signing an executive order in November last year that prohibited any transaction involving publicly traded securities of communist Chinese military companies, in short CCMs. It applies to all transactions by a US person, including individuals, private equity funds, pension funds, institutional investors, banks, everything. This ban will take effect on the 11th of January for the CCMs that are already on the list, and for the investors of the companies that might get on the list, they would have 60 days of grace period to divest out of the companies before they get delisted. There are 35 companies that are currently on the list, and these are the ones that are currently trading on the US or Hong Kong Stock Exchange. You can pause the video to have a look. If not, let's move on. China Mobile, China Unicom and China Telecom are getting listed on 11th of January, and China National Offshore Oil Corporation should be getting listed on 1st of Feb if you calculate using the 60-day grace period. So other than these companies, how many others can face delisting? As of October the 2nd, there were 217 Chinese companies listed in the US with a total market cap of 2.2 trillion. Out of these, 13 companies are Chinese state-owned enterprises, which in my opinion would be at a greater risk of delisting. Only a handful of the designated CCMCs are listed in the US at the time of the executive order, with the oil giant China National Offshore Oil Corporation being one of the last to be listed in the major American exchange. However, a number of high-profile Chinese companies that are listed in US, such as Alibaba and JD.com, has sought to take secondary listings in Hong Kong as the relationships between China and America have worsened over the past 2 years. More companies are expected to pursue secondary listing closer to home on a Hong Kong Stock Exchange as a hedge against the rising tensions, with an option to convert them to primary listings if necessary. Trump also signed a legislation last month that can remove Chinese companies from US exchanges if American regulators are not allowed to review their financial audits. The Holding Foreign Companies Accountable Act will require companies to establish that they are not controlled or owned by a foreign government. And they should also allow the US Public Accounting Oversight Board to review their financial audits within the next 3 years. These two legislation also mean that the companies that might get delisted won't be able to trade on the over-the-counter or OCT market, unlike the companies like Lunkin Coffee, which is currently trading on the OCT market after getting delisted when the financial fraud that they did came out. So the question now is, what should we do going forward? Well, for non-American holders of these ADRs, you have two choices. Either you can sell all your shares or you can exchange them with Hong Kong shares. These ADRs are fungible, and Bank of New York is acting as a depository, and they will be handling all the exchange requests. Each ADR would convert into 100 Hong Kong shares for China Telecom, 10 for China Unicom, and 5 for China Mobile. Now, what should the people who are not already invested into the company should do? Well, if you were looking to buy into these companies before Trump came up with his shenanigans, you should be more than willing to buy the companies right now. The drop in the market has nothing to do with the current situation of the company's business. All these three telecom are solely based in China, and they are not affected at all in terms of business. The sole purpose of these ADR was to raise capital for these companies, and that purpose was fulfilled a long time ago. Yes, with the recent restriction, the biggest capital market won't be able to trade these stocks, but that is just a short-term effect, and you should be taking advantage of this. The global investors will make up for the shortage in a couple of years. Until then, just enjoy the juicy dividends. Also, American investors do not account for a large percentage of shareholder in any of the affected telecom firms. China Mobile, which has been listed in the US for last 2 decades, have the largest portion of its shareholder base in the US, It accounts for 2% of its total share capital. US listed ADR only account for about 1% and 0.57% of the total shareholder base of China Unicom and China Telecom respectively. However, when going forward to invest in any companies that you might think have ties with the Chinese military, and definitely if they are state-owned enterprises, you should try to hold on your tits and wait until they get targeted. Once the dumping starts, you can pick them up at a cheaper rate. Remember that it's not just the retail investors who are selling their shares, it's also the big indices like MSCI and FTSE. These big investors don't only hold the ADRs but also the Hong Kong shares, and large-scale selling of these shares would definitely put a downward pressure on the share price. So that's about it for today. Like always, if you're interested, just subscribe and stay tuned. Until the next video, ciao.